What's going on, guys? Welcome back to the channel. My name is Tyler. I'm glad you can join me for this intraday update on AMC. We have a lot of very important information to go over that you guys need to be made aware about. The break above $40 that I do expect to be happening in the next couple of hours at the least. We're going to take a look at the option chain, the technical analysis, as well as the Ortex data. But first and foremost, if you guys are subscribed to this channel and we're waiting around for the videos that were supposed to come out yesterday, there was an unexpected family emergency. I had to do a lot of driving, so I was unable to even make a post or a video nonetheless explaining what was going on. But we are back at it. We are back in action, ready to give you guys all the information you need to be made aware about. Keep in mind, throughout this whole video, we are going to be mostly going over facts like we usually do, but if I base any expectations, especially around this forced liquidation situation that is coming this Friday, these are only my expectations. Don't base your expectations based off of what I say. I'm not a financial advisor, not a financial planner, or your dad. Unless you want me to be down below in the comment section, let me know. Some of you guys are into that. That's cool with me. But let's get into this video. Make sure to hit that like button, as well as comment down below what are you doing with your AMC position, while also at the same time consider subscribing to the channel. So getting into it, guys, we're looking, in my opinion, for this breakout past $40. This has been somewhat of a resistance level. We went over this. This was July 21st when we obviously went to $46, bounced right off of our 200-day moving average, which is going to be very important. But before we get to this 200-day moving average, which is currently at $48.65, we have to break out past 40 and hopefully hold $40. Every time we do break out of this, it's not very rare that we break out past 40, but it's rare that we actually hold above 40 for multiple consecutive days. But I do expect that to be happening. We got to take a look at the option chain and the Ortex data to give you guys the full rundown of this. And first things first, let's take a look at the options data. I was going to go over Ortex first, but the options is very important here, guys. The $40 strike expiring this Friday has over 13,000 for open interest. So if the market makers are taking, let's say, 90% of the back end of these trades, so controlling 90% of the potential shares that they have to buy back, then once we do get close to this 40, like right at 40, you're going to see a lot of hedging going on. You're going to see a lot of open market buys coming in from the market makers to oblige for the sell end of these contracts, because when you buy a call, you have the right to buy 100 shares at, let's say, $40. When the market makers, they will sell you that call to keep the options market liquid. They have to literally buy enough shares for these contracts to sell them to you at 40, and the market makers, they don't like to lose money. So probably at $39.50 or higher, you're gonna start to see market makers buying shares. And considering 13,000 in open interest, that is 1.3 million potential shares on top of all the shares that apes are holding and continuously buying. I think you're gonna get that boost past $40 probably by the end of trading today. As you guys can see, though, we're starting to get this move. Obviously, we were kind of down today at about $36.08 for the lows. We have since bounced right up over that. If you're looking at the 15-minute candlestick chart, we are well above our 200-day and our 50-day moving average. Our 200-day is at $38.31, so I shouldn't say well above, but nevertheless, still being above is better than being under. So that is basically all you guys need to know. Let's take a look at the intraday volume for today, which is very low at about 46 million in volume so far. So it's a toss-up. We're about halfway through trading right now. It's 12:23 p.m. So I do expect us to probably double up in volume again, but relative to the move that we are seeing, up 2.21%, getting a lot of volatility right now. You can see this percentage is moving around a lot. The fact that we have had this drop off in volume and we are not cratering in price and we are actually going up, that is a very bullish thing right there, because obviously, like I talk about in all these videos, we're gonna have to see the volume come back before we're even talking about the short squeeze is starting or is about to start. But when we get to this forced liquidation situation, I think this can have some huge implications of what will possibly happen with AMC stock. Keep in mind, this is a possibility, guys. I'm gonna give you guys my time frame, but if you are unaware, this is something you have to know about. Friday, July 30th, this upcoming Friday, the Federal Reserve is looking over the bank's balance sheets and who is their biggest clients they lend to. Obviously, if you have a mortgage through a bank, they don't care about that. They care about people like Citadel, other hedge funds and institutions, potentially other banks that these banks are lending to see if they are in too many risky assets, specifically around the derivatives market. Because if you guys are unaware, the derivative market in a whole is worth more than everything in the world. Take all the buildings and add them up, literally every building everywhere, add up the value of that, you're still looking at about half the total amount of the derivative market. The derivative market is anywhere between $650 trillion dollars, trillion dollars to $1 quadrillion. The whole entire real estate market is only projected to be worth about $300 trillion, and that is global, around the whole entire world. So this is a huge deal, and like we all do know, hedge funds and institutions specifically are very over leveraged, but also banks at the same time, they're not necessarily over leveraged, but they are lending out to people that are over leveraged. If they default, then the bank will be in a lot of trouble. So what is essentially happening? Like I said, the Federal Reserve is going over who the banks are lending to, look at their balance sheets as well, but if they're in too many risky assets, they will be forced liquidated. And obviously AMC is arguably the most risky asset you could own if you are a short seller in AMC, given the strong community of apes that are just holding on to their shares, and the fundamental business is getting much better. Also at the same time, a lot of these shorts took on short positions at about $10 to $15, so they're severely underwater. So essentially what is going to happen, I keep going back to this, but what is going to happen if the banks don't force the hedge funds and institutions to get out of their riskiest positions, then the Federal Reserve, the FDIC, will come in and force liquidate their positions. That is very important, but they do have a 14-day period. So if they are deemed to have too many risky assets, they have a 14-day appeal process. Once that 14 days is up, that is where they will really have to liquidate these positions. But we are already seeing banks like Wells Fargo cutting personal lines of credit. You see Goldman Sachs selling out 25% of their investment branch, likely due to this situation that is coming on this Friday. This has only happened during the last 2 weeks or so. So I do think you're seeing a lot of deleveraging on the bank's parts, but you're not seeing the shorts actually covering or being reflected that they are getting out of their riskiest positions. Obviously, like I said, AMC is one of the riskiest positions, and they are not covering, they are not getting out of their positions. But take a look at this, the OTC derivatives in trillions of dollars, guys. This is only over the counter. This was 2 years ago, so roughly 2019, JP Morgan had over $40 trillion of derivative exposures. So as we do know, a lot of these risky trades are in derivatives. Once you default and start to lose on these derivatives, you can lose 100 to 1. You can lose a ton of money. So odds are there will be a lot of forced liquidations, but I don't expect a move coming Friday. I really expect a move coming that next week. So July 30th, I don't know when Monday is, but that next following week after that, this upcoming Friday, and then possibly that next following week. So this could be a multiple week event, but I do think you're gonna see a lot of price action with AMC to the upside. Now we also have to talk about why AMC did fall so much yesterday, because I was not oblivious to what was going on. I know exactly what was going on with the whole situation. AMC did drop a lot. Especially at one point, everything was down a lot. It really revolves down to China and what market makers and algorithmic trading programs were doing. When you have a lot of negative sentiment, it's not necessarily what is going on with the business if shorts are covering any of that stuff. It can be affected by just market sentiment, by the overall negativity in the markets, which was going on because of China. But I am not too concerned about this, especially when it does come to AMC. We did have China that basically reversed on what they said. They said the sell-off we did see yesterday and the following 2 days before that was a big overreaction, and you really shouldn't expect anything else dramatic coming from China, because you guys may or may not know this, but China actually declared that all educational companies, or aka the stocks, all these educational public companies, need to go non-profit, citing a lot of issues with basically privileged people in China being able to get access to education and other people in China aren't. But unless we get some escalation to that situation, you're not going to see the stock market being affected at this point, considering we're seeing a pretty decent balance for today. So I think a lot of that baby mama drama, that drama is over with. But let's get into the Ortex data, guys. Keep in mind, this may or may not be accurate. This, in my opinion, is not accurate, considering when you do factor in naked short selling and synthetic short selling, I do think the actual short percentage is a lot higher, well above 20%, probably in the range of, like I always say, 40 to 80% on a realistic basis. But the short interest change for today, negative 0.1%, return shares 1.13 million, borrowed shares 1.03 million. So that is a borrow change of negative 99.5 thousand. Current short interest percentage of free float at 15%. Current shares that are sold short of 76.66 million. Guys, keep in mind, this may or may not be accurate. Let's say it is accurate. And relative to the volume that we have been seeing, 76.5 million shares that are currently sold short is a large amount relative relative to the volume that we are seeing. Obviously, we are seeing lower volume. At the time of this recording, last time I just looked, we were at 46 million for volume. Imagine if all that volume was buys, you'd see shorts obviously getting squeezed, you'd see the price going crazy, but you'd still have about half the current shares that are still sold short. So you're seeing a low amount of volume, which is good for the overall short squeeze. Once you do get that volume coming in, obviously you're going to see a lot of shorts pick up short positions, and you're going to just overall see the stock go crazy. So relative, if these numbers are correct or not, this is still looking fantastic, categorized as extreme short interest. But keep in mind, some of these return shares are probably because the free flow on loan is much higher than the actual short interest. The free flow on loan is 19.13%, whereas like I said, the short interest percentage of free flow is at 15%. So what essentially that means, the free flow on loan, is hedge funds and institutions, before they actually sell a stock short, they have to take that stock from a broker and then they hold it in their account, and they can decide when they actually want to sell the stock short. The only thing is they pay interest in the meantime. So right here, this is not covered shares, these are return shares and borrowed shares. So obviously a lot of this is probably return shares, because we do know shorts more than likely are not covering a single share. They're really trying to hold out and obviously digging themselves in an even deeper hole. But that is pretty much all I do have for this intraday update. We're going to be going over much more about how the hedge funds and institutions are actually loading up on AMC shares in a follow-up video later tonight. So stay tuned for that. If you guys want to be notified as soon as that is posted, make sure to hit that notification bell, as well as consider subscribing to the channel. Also, like I said, comment down below. Let me know what you are doing with your AMC position. How much are you buying? Are you selling out at a certain price? Are you just buying the dip? Are you buying every day? Let me know. Are you buying when you get paid? That is all very important information. I would love to hear from you guys, as well as like the video on your way out. Also, if you guys want to get totally free stock with a brokerage that does not use payment for order flow, check out the link for public. Your orders go straight to lit exchanges. You ultimately help cut down on Citadel's or payment for order flow, their big deep pockets, while also at the same time really helping to influence AMC stock price with your buy orders. But you also get up to $70 in your choice free stock in about 3 minutes time, with no need to link a bank account or deposit a single dollar. So definitely check that out. But that is all for this video. I will see you guys in the next one.